Coach. And with me today is Jennifer Foster, our investment coordinator. Jennifer, welcome.
Hey, Royce. Really excited to continue our series on investor expectations. We've been covering some of the most common questions that we heard since 2014 and early this year. So we started with why am I underperforming the S&P 500? And then we talked about why am I in international stocks? And then today we're going to cover why do I need a coach or an advisor? With all these online trading things, it's so funny. This lady tells me the other day, oh, well, investors are becoming more savvy and they can just do it online. And just because you can trade something online does not make you an expert, just as much as just because you can reconcile your QuickBooks makes you an accountant. Right. So we're going to discuss why it's important to have a coach.
Or if you had a bone saw, you could be a surgeon.
Sure.
You know, do your own surgery, brain surgery or whatever.
I'm sure they have a dummies book for that too.
Well, actually, you can buy a bone saw online. They're only about, I think they're less than $30. I've been tempted to get one. So anyway, Dalbar Research. Dalbar is an organization that every year takes a look at what the investor returns have been. And a lot where they get most of their information is from institutional or retirement type accounts, because there's not as much movement in there. And from 84 through 2013, what they found, that 20-year period, the annualized return of the S&P 500 index was about 11.10%. But what we find is that the Dalbar average investor in their equity funds received a return of about 3.69%, and inflation during that period of time was at about 2.8%, which means that the average investor in equity funds received less than 1% return. And if they had enough money and it was not in a tax-deferred account, they may have had the pleasure of paying income tax on this also, which would have meant that you probably had a negative return. But looking just at the data, that for the average investor, whether they did it online, however they did it, that is not a great return. And I can see why so many people get upset or frustrated with being an investor in the market. Because when you try and do it on your own, or if you're getting advice that's not worth what you're paying for it, it has a negative effect on your investing performance.
Right.
So,
and our clients have been utilizing these structured institutional portfolios, and so we're going to take a look at what those portfolios have done since inception. So we use our money manager, Matson Money. These are all GIPS audited returns.
Right. And what they're looking at, the reason why we're going with the 95% equities and 5% fixed income is the Dalbar study. Remember on the slide, it said the performance of the equity funds, the equity returns of investors. So we want to look as close as we can to equity versus equity.
Right, because the S&P is full equity. This one here has 5% fixed income, so it's the closest comparison to all equities, which, I mean, it's very aggressive in that sense as in comparison to the S&P. So the consumer price index $1 million during the 2000 to 2014 time period grew to $1,395,000. Now this is an index, so the income and growth net of fees was $1,544,146. Now income and growth has 75%. I'm sorry, 50% fixed, 25% fixed income.
Jeez, I think we better start this one over again. Oh.
You didn't have to. You can